Ladies and gents, the burning question on my mind right now would be, is CVS Health Corp too cheap to ignore, too good a value to pass up? As you know, I do consider myself to be a value investor, and since the primary thing I look at is valuation, I think with CVS being down almost 25% and being a large, stable company in an industry that I think is probably poised to be a growing pie, which is healthcare, I think it's the right time to be taking a closer look at this company. So, in addition to being the retail pharmacy that we all know as more or less the Pepsi to the Coke that is Walgreens in the retail pharmacy space, they are also in the pharmacy benefits management business, as well as the proud owner of Aetna, which is a major health insurance provider, similar to like a Blue Cross Blue Shield or a United Healthcare type business. And if you want to look, those businesses have done, I believe, pretty well over the last couple decades. I've taken a very brief overview kind of look of United Healthcare, and they have just had some really, really impressive results for their shareholders over the last couple decades. Now, CVS, being in each of those businesses that are in the same sort of healthcare space, but not like the exact same. So that's what we call a vertical, right? So you have the things that are in the sphere of healthcare, and if they had tried to, like, say, buy Walgreens, that would be considered like a horizontal. They would be trying to capitalize on the retail healthcare pharmacy situation, but by going after like pharmacy benefits and health insurance, that's more of a vertical. They're saying, hey, we want to be your insurance provider, we want to be your retailer of choice, we want to provide you with your pharmacy benefits. They also provide a lot of really nice services, again, in their pharmacies that are very convenient. I've personally been in, gotten different vaccinations, etc. there. Pretty good user experience. I don't have insurance from Aetna, but I see what they're going for, right? It's pretty basic stuff. Now, with regards to the business itself, we can see solid revenue growth over a period of time, right? Now, 2019, you see like kind of an outsized growth number, and you see a large issuance of shares, an issuance of shares that's slightly less than the revenue growth number, percentage-wise. I'm guessing that's probably the year of the Aetna acquisition, just common sense kind of jumping out at me there. And if EPS, okay, so this last year there must have been some kind of big expense of some kind that chopped their EPS almost in half. Now, I looked into analyst estimates for their EPS going forward, and it does look like that was a temporary blip. 2023, it's actually expected to be over $8 according to analysts. So I would not use this as a starting point for any kind of evaluation calculation. Now, the free cash flow has been quite a lot higher than the EPS the last few years, which is actually, if anything, a positive thing. But we will use this year's estimated EPS when we go to our discounted free cash flow. But before we do the discounted free cash flow, I just want to address the balance sheet elephant in the room. Okay, so little tip. These data feeds are good for like kind of like a very zoomed out view of, you know, what their overall asset and liability situation looks like, okay? But some of the specifics are going to get lost in translation, okay? Now, what that data feed did not show was the long-term operating lease liabilities, okay? Now, the reason I think that's important to kind of point out is some data feeds, etc., will just call these like other long-term liabilities, or they'll even, you know, in some cases I've seen them get lumped on like and added to the long-term debt. And in other cases I've seen on data feeds the long-term debt mislabeled as leases on the ones that have a spot for it. So be careful just trusting what's in the data feeds, because some of the stuff can get lost in translation. You know, usually the actual bottom line of like total liabilities and total assets will be, you know, correct or very close to it, and you can, you know, get a very generalized view from the data feeds. Now, that being said, when it comes to the leases, the fact that you know, about 10% of their total liabilities and what I would call a pretty big chunk of like their long-term liabilities are basically from these leases, I think you got to cut them a little bit of slack on the tangible book value, especially because a lot of their intangible book value comes from goodwill, which I'm going to, you know, take a shot in the dark and say that a lot of this goodwill is probably from the acquisition of Aetna, and, you know, other acquisitions as well. But the thing is, the goodwill is basically the difference between the net asset value of what they acquired and the price of the acquisition. So unless they paid exactly the value of the assets for an acquisition, which for a good accretive acquisition, you're probably going to not just pay the value of the assets. You're probably going to be paying, you know, a pretty, you know, reasonably, you know, normal or even premium multiple on the target company, right? But if it ends up being accretive and adding, you know, a substantial amount of earnings and cash flow growth for your shareholders, it's a good acquisition even if you paid more than the net asset value for the target company. So I don't necessarily like penalizing them on the tangible book value, just because the acquisitions they made were potentially of a high quality and synergistic with their business, and provide a vector for continued growth in their earnings and cash flow over the long run. So that being said, I want to pop over and run a little bit of a valuation scenario. So with a standard 10% discount rate, with the average analyst estimate of 2023's EPS, and a 5.5% estimated compound annual growth rate on the EPS, with that dropping to about 3% over the subsequent 10 years, we come up with a fair value of $112 per share. Now, personally, I rarely go with a straight 10% discount rate for my personal goals. Like, I want, honestly, to beat the market. So something solid like you know, CVS, I would be comfortable with, you know, saying, hey, I want, if my assumptions turn out, to get a 12.5% annual return, which means that's what I'm going to put as my discount rate. So purely from the perspective of the stream of earnings that this company is expected to provide, the current value today would be something along the lines of $92 to $93. Okay, if you wanted to get a 12.5% return, if you believe my other assumptions, leaving us with a margin of safety of almost 25%. Again, even with applying the more conservative 12.5% discount rate. So, yes, this is an incredibly cheap business if you believe the assumptions about this turning out to be 2023's annual EPS and this growth rate of 5.5% over the next 10 years. And that's, of course, also if you agree with my sort of judgment call not to deduct the tangible book value off the share price. Now, you could still do that, right? And you could say, hey, I need this to be in the 60s, low 60s before I'm interested. I mean, that's perfectly fine, right? I'm all about being more conservative. And if you do that, I mean, you could still justify a slightly market-beating return at today's price, just not a 12.5% return. You get between 11 and 11.5% if you decide to dock them for the tangible book value. That's still pretty reasonable, right? I don't think that's an unreasonable thing. I mean, for a stable business like CVS in the healthcare space that is expected to be, a pretty solid grower, healthcare is certainly not going away, right? I could see, maybe getting it a little closer to just, its actual, market value, which again, 10 is kind of the standard because it's been the long-term return of the S&P 500 for the last 40 years or something. So people tend to consider 10% to be about the market return and want more than that if they're buying individual stocks, in my view. Some people are okay with just matching that on paper, and that's fine. Different strokes for different folks. But yes, I would say at this point in time, any way you slice it, CVS is getting into that zone where it's getting too cheap to ignore. And personally, I'm going to do a little bit more tweaking with this and potentially be putting it on my watch list. Let's call it $70. It's just 16 cents over that right now. So, yeah, I think I'm interested in it just with what I'm seeing with some of the more conservative assumptions we're making. Yeah, I think 70 or below is probably where I'm going to end up being interested in CVS. So let me know down in the comments if you agree with the fact that CVS is becoming too cheap to ignore. Hop on Discord if you want to discuss it with me in real time in more detail. Always happy to do that. Link is, of course, in the description. Like the video if you liked it. Subscribe to the channel if you want to keep having these discussions about different companies and investments. Take it easy, everyone, and cheers.